Let's conclude this section with a description of tax and how that can be affected by discounting. Now, we're not going into economic policy or fiscal policy here. We are saying that we're taxing an individual based on their income and their capital gains. So income tax, whatever you earn, you'll be paying a certain percentage over to the government. Capital gains is if you sell an asset that you purchased at a cheaper price. That capital gain that you make may also be taxable. Now, most governments will charge different tax rates for those two amounts. To be honest, in the majority of countries, capital gains is a lower rate than income tax. So let's now have a look at an example and see how this works. You buy a share for $100. This pays a dividend of $6 at the end of each year. After 3 years, the price has risen to 120 and you sell the share. Using 10% discount rate, calculate the NPV of the investment with no tax, first of all. So we buy a share for 100 minus 100. We are getting in a dividend of 6 at the end of each year. So there's 6, and there's the end. The price has gone up to 120, so we sell it for 120, but you've also got the 6. So using a 10% discount rate, calculate the NPV of that. Let's do that first of all without any tax. So please press pause, use a calculator, use whatever method you want, do this manually if you want, and work out the present value of that at 10%. So please have a go at that now. I'm going to calculate this using the bond keys. Now you could use the cash flow function and put in 6, then 126, that would work. I'm going to do the bond keys and say n is 3, I over y is 10, payment is 6, FV is 120, and therefore compute present value gives 105.08. So the benefits of this investment are 105.08. If we want to work out the appropriate value, it's 105.08 if there's no tax. Now, minus 100, so the reason why is it negative? The reason it's negative is because that's what you would have to pay for it if it's a fair valuation. So you'd pay 105, but it means that's the positive present value of the future cash flows. So 105.08. If we want to work out the net present value, it's going to be that minus 100. So 105.08 is the benefit of the future cash flows. You paid 100 to buy it, and so the overall net present value, if it didn't say net, you'd say, well, this investment is worth 105.08. But because it says net, you said, what's the overall benefit of this investment? Answer, you paid 100 for it, and therefore your benefit is 5.08. 5.08. I want to do this in a different method to show how we can do this in one go. So the net present value, I'm going to use the cash flow function this time. So second clear work, CF0 is minus 100, CO1 is 6, down, down, CO2 is 6, down, down, CO3 is 126. So you've got your final 6 coupon, your final 6 dividend rather, and your 120 sales price, enter. Press NPV, we're using 10%, enter. Scroll down, compute, and there's your 5.08. So using a 10% discount rate, that's the net present value without tax.